Turning $10,000 into $1 million may sound like a pipe dream, but with the power of dividends and compounding, it's actually more achievable than you think. I know, it sounds too good to be true, but it's actually possible. And it all comes down to one powerful strategy: dividend investing. In today's video, we're going to explore how this strategy, often called the dividend snowball effect, can help turn small investments into massive wealth over time. Many people think of dividends as something only retirees care about. But the truth is, dividends can be a game changer at any age. The key is patience, smart choices, and letting compounding do its magic. So whether you're in your 20s or your 40s, if you start investing today, your $10,000 could snowball into much more than you expect. Let's begin. Chapter 1: The Power of Compounding. Let's talk about compounding, the secret sauce behind turning small investments into something much bigger. Simply put, compounding is when your money earns money. The more time your money has to grow, the more it works for you. Think of it like this. If you invest $10,000 today and it earns 10% per year, in just 1 year, you'll have $11,000. It sounds simple, but here's where compounding shines. The next year, you're not just earning 10% on your original $10,000. You're earning it on the $11,000 you have now. Over time, this snowball effect kicks in. Your money starts growing faster and faster, and you don't have to do much to make it happen. Now, imagine this process happening for 20, 30, even 40 years. That $10,000 could turn into hundreds of thousands, or even $1 million, just by staying invested and letting compounding do the work. And the best part? You don't need to constantly watch the market or pick the next big stock. It's all about letting time and compounding work in your favor. That's the power of compounding. Chapter 2: What is the dividend snowball effect? So, what exactly is the dividend snowball effect? In simple terms, it's how dividends work together with compounding to grow your investment faster over time. Let me explain. When you invest in dividend-paying stocks, these companies give you a portion of their profits, usually on a quarterly basis. It might not seem like much at first, especially with a $10,000 investment, but the real power comes when you reinvest those dividends. When you reinvest, you buy more shares of the same stock. Now, those additional shares start earning dividends of their own. Over time, this creates a snowball effect. The more shares you own, the more dividends you receive. And as your dividends grow, you buy even more shares and the cycle speeds up. It's like planting a tree. At first, the tree is small and the growth seems slow. But as it matures, it starts growing faster and faster, and eventually it becomes a forest. The key to this effect is consistency, investing in quality dividend stocks and allowing time to do the heavy lifting. As the dividends grow and reinvestment continues, your wealth starts to snowball. Chapter 3: Historical Case Studies. Now, let's take a look at some real-life examples of how the dividend snowball effect can work over time. These case studies should help bring the idea to life and show you the potential of dividend investing. First up, let's talk about NVIDIA. You've probably heard of NVIDIA, especially with its recent boom in the AI space. But did you know that a $1,000 investment in NVIDIA back in 2009 would now be worth over $363,000? That's right! And this wasn't just because the stock price skyrocketed. Dividends were also a factor. While NVIDIA's early dividend payments were small, the company's growth, combined with reinvested dividends, turned that small investment into something massive. NVIDIA's strong position in the tech and AI space shows just how a company's innovation can create both capital appreciation and dividend growth over the long term. Next, consider Eli Lilly, a company that's made waves in healthcare with drugs like Ozempic and its potential Alzheimer's treatment. Over the past 5 years, a $10,000 investment in Eli Lilly would have grown to over $66,000. While this isn't quite the $1 million goal we're aiming for, it shows the power of holding on to high growth, high quality dividend stocks. Eli Lilly's steady growth, combined with its increasing dividend payments, makes it a strong contender for the dividend snowball effect over time. Finally, let's look at Advanced Micro Devices, or AMD. This company has been transforming the semiconductor industry with its cutting-edge chips. While AMD's dividends may not be as high as some other stocks, the combination of rapid growth and reinvested dividends has created a great opportunity for long-term investors. Over the next decade, as AMD continues to capitalize on AI and other tech innovations, its stock price and dividend payments could grow substantially, making it another example of how the dividend snowball effect works. These case studies show that dividend investing isn't just about picking stocks with the highest yields. It's about finding companies that can grow their dividends over time and reinvesting those dividends to create even more wealth. Chapter 4: Key Strategies for Dividend Investing. So, how can you take advantage of the dividend snowball effect to turn $10,000 into $1 million? It's all about having a solid strategy. Here are a few key approaches that can set you up for long-term success. First, start early. Time is one of the most powerful tools in investing. The earlier you start, the more time your money has to grow. Let's say you're in your 20s and you invest $10,000 today. Over the years, that $10,000 will grow thanks to compounding and the dividends that get reinvested. The earlier you start, the bigger the snowball grows. If you wait until later in life to start investing, you lose out on all that early compounding power. Starting early means that your money works harder for you over time. Next, reinvest your dividends. This is a crucial part of the snowball effect. Instead of cashing out your dividends, reinvest them to buy more shares. This creates more shares, which in turn pay you more dividends. It's like planting more seeds in your financial garden so they can grow into larger trees. Third, focus on high-quality dividend-growing stocks. You don't need to pick the highest-yielding stocks, but you do want companies that consistently raise their dividends. Companies like Apple, Microsoft, or Visa have a history of not just paying dividends, but increasing them year after year. Their strong financials and consistent growth make them ideal for long-term investors looking to harness the power of compounding. Finally, diversify your investments. While focusing on a few high-quality dividend stocks is important, diversification helps reduce risk. You can also consider ETFs that focus on dividend-paying companies. Funds like the Invesco QQQ give you exposure to top tech stocks, which often pay dividends and grow at a strong pace. A well-balanced portfolio ensures that you're not putting all your eggs in one basket. By starting early, reinvesting your dividends, focusing on quality, and diversifying, you'll set yourself up for the snowball effect that can turn your $10,000 into much more. Chapter 5: The Mathematics of Reaching $1 million. Let's break down the numbers and see how the dividend snowball effect works in practice. If you're wondering how long it really takes to turn $10,000 into $1 million, it all comes down to the power of compounding and steady growth. Let's say you're able to average a 15% return per year. While this might sound ambitious, it's not out of reach for long-term investors in high-growth dividend stocks or ETFs. Over the first 10 years, your $10,000 would grow to around $40,000. Not bad, right? But here's where compounding really kicks in. After 20 years, you're looking at about $163,000. And the real magic happens in the next decade. By year 30, your investment would be worth about $662,000. And in just 33 years, that $10,000 turns into over $1 million. This might seem like a long time, but remember, the longer you stay invested, the faster your wealth grows. The secret is consistency and patience. Your money doesn't just grow on the original $10,000. It grows on the dividends, the reinvested dividends, and the additional gains that build on top of each other. So, whether it takes 30 years or less, if you stay invested and keep reinvesting those dividends, the math will eventually work in your favor and turn that $10,000 into something much bigger. Chapter 7. Risks and Considerations. Of course, no investment strategy is without risks, and dividend investing is no exception. Let's go over some key risks you should keep in mind. First, market volatility. While dividends can help smooth out the ups and downs of the market, stock prices can still fluctuate. Economic downturns, for example, can hurt both stock prices and dividend payments. Some companies may even cut their dividends during tough times. Second, over-concentration. It can be tempting to focus too heavily on one stock or sector that's paying high dividends, but this can expose you to greater risk. For example, if you put all your money into one stock and that company faces trouble, you could lose both your dividends and your principal. Finally, inflation risk. If inflation outpaces the growth in your dividend payments, your purchasing power could be eroded. To protect against this, look for stocks with a history of increasing dividends to outpace inflation. By staying diversified and focusing on quality companies with a solid track record, you can manage these risks and stay on track for long-term growth. To wrap things up, the dividend snowball effect is a powerful tool that can help you turn a small initial investment into a much larger sum over time. If you enjoyed this video and found it helpful, make sure to give it a thumbs up and subscribe for more insights on how to grow your wealth over time. And if you're already investing in dividends, leave a comment below and let us know how it's working for you. Thanks for watching, and I'll see you in the next one.